Thanks, Jeremy. So we're here to talk about structural modeling. And because this is such a new field in accounting, what I wanted to do in this very first session is to just set some sort of perspectives in terms of how I think about structural modeling and how I think structural modeling fits into the other types of empirical work there is out there. So what we're going to cover in this session is we're going to go over what is the thing that all empiricists are trying to do, and then we'll kind of divide it along with what is structural and what is everything else. So basically, the way I consider empirical work, there is structural work and there is descriptive type of research. And there's definitely a role for doing descriptive work. There's a role for doing experiments, but there are limitations to those methods. And that's where you might want to think about doing structural modeling. So of course, I'll spend a lot of emphasis defining what it is and just go over what are the things you want to highlight and what are the things that you want to be careful about in terms of its downfalls. And then I'll end the presentation with some examples of structural papers which I think are really good at illustrating why structural modeling has its advantages, and also how those papers were really good at dealing with the criticism that you will see from a referee or from a typical audience who has not been exposed to this type of work. All right? I encourage you to ask questions. I understand kind of this is intimidating, but sort of this is supposed to be a casual session, so jump in with any objections. I might have made some mathematical errors and incorrect assumptions along the way, so keep an eye out. I'd be definitely interested in hearing from you.
Do you mind lowering the board?
Oh, my understanding is...
Are you going to use... Go ahead.
Okay, all right. It does lower. All right, so if you're an empirical researcher, and I consider structural work to be sort of a subfield under empirical research, then of course, the starting point to every research project is going to be the data. So suppose in the raw data, you observe a set of X's and a set of Y's. And a common goal for every empirical researcher is to provide some characterization about the joint density of X and Y, right? That is a very general statement, but if you look at empirical papers, that's what we're trying to accomplish at the end of the day. So if you look at the joint density, typically researchers have to make a choice about exactly which aspect of that density to highlight. So we can start with a very general choice. So for example, we can ask about the conditional density of Y given X. We can go a little bit more specific. So instead of asking about that conditional density, we can just characterize the conditional expectation. And of course, we can then go one step further, say something about the deciles of Y given X. And last of all, and the one that you're probably most familiar with, is the best linear predictor of Y given X, right? So we will kind of go through each of these in more detail. But as you can see here, if you're looking at just the raw data, right, you will immediately realize that none of these features of the data can be presented to the user completely non-parametrically. So if you're doing empirical work, sort of one of the realizations that we have to agree on is that you have to make an assumption before doing anything with the data, and those assumptions have benefits and they have costs. Okay? And the point is that when it comes to the assumptions that we're imposing on the data, they're fundamentally something that is not testable. How do you defend them? Well, you try to use some of the features of the real life institution that you're modeling in order to justify the assumptions. But there's no amount of statistical methodology and wizardry that's going to provide your user with a convincing case for why that assumption makes sense. Okay? So of course, if we look at the list of what to tell the users, the most common one that you typically see will be the BLP, right? The best linear predictor of Y given X. And let's just talk a little bit about what exactly we're doing there when we calculate the BLP. Okay. So the BLP has some nice econometric properties, and that's why you see it applied so often in empirical research, right? So what we're doing here is that we are imposing a functional form assumption about that conditional density of Y given X. At this point, we don't know what to call Y yet. We don't know what to call X yet, right? So we're still in the statistical realm. So if we make an assumption that that conditional expectation is linear up to an error term, then we can apply some statistical assumptions about the error term having mean 0, the error term being uncorrelated with your x variable, and the variance of that error term being constant across all of the x's, right? So those are what you would consider the typical OLS assumptions. Most of us have gotten exposed to this so far in an econometrics class, I would think, right? So with those statistical assumptions, then of course we know that when you calculate b hat by minimizing that square distance, it's going to be a consistent estimator of b. Okay? So if we are looking at the conditional expectation written in the following form up there, well, I can say something about identification. Okay? What do I mean about identification when discussing this pure statistical object? All I can conclude is that when I have my OLS usual assumptions, the b hat that satisfies that minimum square distance estimator has a unique minimum. Okay? And you can show that sort of analytically with some of the steps that you would have learned about in your econometrics class. Okay? So when it comes to identification, so far all we're talking about is a statistical concept, right? It's to show that that beta exists. So the question is that beta, I called it B here, is that B going to be something that is interesting to the researcher from an economic perspective? And without any further assumptions, that B is not going to provide any interest, right? So there are cases where you can actually layer on some assumptions. And in those rare instances, the beta hat that you get from estimating that OLS regression corresponds exactly to some sort of underlying economic primitive. So the one example I've given here is the Cobb-Douglas production function, right? So if you assume that y is productivity and the x's is like a vector of inputs like labor and capital, well, it turns out that when you estimate that regression in log form, then the corresponding b hats you get would tell you something about the total factor productivity for this economy, as well as the cross elasticities to labor and capital input. Okay? So that's one special case. And one note I wanted to make here is that sometimes we call this OLS regression the reduced form, right? Many of you have heard that terminology before. And sometimes the term reduced form is used to mean the opposite of a structural model. And I kind of, sort of in my research, I avoid that description. Why is that? Well, in this case, when you estimate a regression with output on the left-hand side and labor and capital on the right-hand side, you are estimating a structural model. Why is that? That expression up here is the reduced form of an underlying structural model. So then if you can identify the b's in that equation, sort of in a statistical sense, you can also identify the parameters of the underlying Cobb-Douglas production factor model. Okay? So that would be sort of a special case. But in general, we don't have that nice close link between theory and data. And in general, the only thing we get from estimating B0 and B1 is the slope coefficient you would apply to your x variable if you wanted to predict the y variable. Okay? So in order to be able to say something beyond the slope coefficient or beyond just the prediction exercise, we need to layer on more assumptions. So in case it wasn't obvious already, turns out that for all empirical work, you need to make assumptions. And the degree of the assumptions you make is going to be correlated with how interesting your inferences are going to be. Okay. So at this point, I want to give you an overview of what we mean by descriptive work. Okay? So in terms of the spectrum of how many assumptions you make, well, if all you do is make an assumption about sort of the functional form of that conditional expectation of y given x, then all you can do is describe the data. Okay? And I think that in all areas of economic research, describing the data is a very useful exercise, and it tends to be undervalued. Okay? What are some of the different roles for doing this data description? Okay? So at the minimum, we can just document facts and patterns that might be interesting to researchers. Okay, just illustrate the sort of the interesting nuances of the data set. What would be one example? Sort of if we're examining the correlation between earnings and returns, right? That is something that is a very useful exercise for capital market researchers. Another role is to figure out how we predict certain variables. Okay, so in accounting, we're interested in whether accruals or cash flows predict future cash flows better, future returns better. That is also a very insightful exercise. Other examples would be sort of bankruptcy prediction models. Which one does better? Should we look at sort of primitive fundamentals, or should we look at something more sophisticated? Okay. So kind of those two are generally under-recognized, and I would say that the next two are the most common roles that you see for descriptive work, right? And those have to do with showing causation and corroborating theory, and sometimes both of them are done together. Okay? So of course, we know that when it comes to showing causation, typically we have to look for exogenous variation in the data. Yes, is it Michael?
Yes.
Okay.
I'm surprised that you mentioned assessing predictability as a sort of as a role for descriptive work. I would think that if you were trying to make predictions about data, you want to be able to model the underlying data generating process, and in order to do that, you need a theory about what the data generating process is. But it sounds to me like you're saying, just we have data, let's just throw it at future data and see what happens.
I would argue that just the pure exercise of making prediction is by itself useful. I'll give you an example, right? I'm teaching an introductory accounting class to master's students at Duke, right? And they need to be convinced that cash is not king and there is a point to learning accounting. So the picture I put up is the Xiao 94 result showing that sort of if you do a horse race between cash flow and accruals and what explains future returns, well, the one that actually gets you a higher R-square turns out to be accrual accounting. So definitely it's interesting in terms of the practical sort of policy, informing policy side of what we do, but also depending on what stage of the literature that the research has progressed along, a pure prediction exercise should be insightful as well. Okay. So most of us know that if we wanted to establish causation, we need to find an X variable that, of course, is exogenous to the outcome variable that we're studying. So the sort of papers do this well or not well to some varying extent. I won't spend too much of the presentation going through examples. What I will say is that when we work on we do this kind of descriptive work purely to show some sort of causal relationship. The justification for why your X variable is exogenous should really come from your knowledge about the institutional setting, not so much about, shouldn't come from some sort of statistical technique, because all those statistical techniques are premised on the assumption that you have the right institutional setting. So the example I'm thinking of is that many times when we see a descriptive study that claims to have exogenous variation through some sort of instrumental variable, I see sort of the Stock and Yogo test applied a lot, the Hansen test. I roughly know what the sort of statistical technique is involved. Having said that, none of those tests are sufficient enough to convince the reader about exogeneity unless you can defend it with the underlying economic setting. Okay? Which brings me to the second critical opponent to be able to show causation, right? So even if you have something that is truly exogenous, you need some kind of economic theory to interpret the underlying causal mechanism, right? So otherwise, even with a random assignment of the X variable, all you can do is say that for any other setting, if I change X by 1 unit, I'm going to see a corresponding unit of change in Y. You cannot say anything about what happens when you go to a different setting and you make a change to some sort of treatment variable again. Okay. So sometimes linked with sort of the causal exercise is the use of descriptive work to test some kind of theory, right? And kind of this is shown, this is common to sort of a lot of the popular topics we see today about disclosure, about types of managerial behavior. And I will say here that oftentimes the theory is not literally is not the right word, but it's not the ideal for applying to every specific setting that we're studying empirically. So as a result, sometimes you can have a very loose link between the two. So in order to kind of show a compelling case for why your empirical work has corroborated a theory, you have to, of course, understand exactly the components of those theoretical models. So I know we have some theorists in the room who probably cringe every time that their theory is misapplied. So some examples I can think of are sort of the exactly timeline of events. So whether Y is something that is truly chosen after X in the model, what is common versus private knowledge, and what is exogenous and endogenous in the model. And it's often the case that there are multiple endogenous components in the particular model, but when it goes, the researcher takes it to an empirical setting, we just assume that all of those is constant and only Y is the truly endogenous variable. Okay? So I wanted to spend a little bit of time on the second set of points here about why a true experiment does not necessarily provide interesting economics insights about causation. So I was thinking of a specific example to use. And most of you probably have heard of the advice that when you're a junior researcher, you probably want to be really careful when taking shots at senior researchers. So keeping that advice in mind, I went and looked at the most famous economist, one of the most famous economists of them all, Ingres and Kruger, and I decided to take a shot at them. Hopefully they're so famous that they probably don't care that this humble junior faculty is taking issues with some of their work, right? So how many of you have covered the Vietnam draft lottery setting in your econometrics classes? Okay. So I would say a little bit more than half of you. So for those of you who have heard it, bear with me, I will just briefly explain the setting. So what the researcher is interested in is studying whether military experience causes an impact on lifelong learning, and lifelong earnings. And in this case, the researchers are interested in quantifying the impact of serving the military on future earnings. Okay? And as most of you should recognize, whether or not someone serves in the military is going to be endogenous. It's going to be endogenous to their type, and it's going to be endogenous, of course, to their future earnings. So what Ingres and Kruger correctly saw is that back in the 60s, there was some exogenous variation to whether young men had to serve in the military, and the exogenous variation they found had to do with this lottery draft, right? So based on the date of birth for the young men who were in the late teens to early 20s, they each got a lottery number, and then of course those lottery numbers were drawn to determine who had to serve in the military. Kind of that's the stylized explanation of the setting. So of course, if you assume that birthday is truly exogenous, then you have an underlying variable which is going to randomly assign some men to serve in the military and some men who don't have to serve. And if you kind of studied sort of the instrumental variable technique before, then you will find that the lottery draft eligibility as determined by the birth date is going to satisfy the conditions for an instrumental variable. So if you wanted to understand the impact of military service on lifelong earnings, you could come up with your instrumental variable estimate, which is going to be the difference in outcomes for military men and non-military men divided by the probability that they were drawn for the lottery. Okay, so that's sort of a standard result that most of you would have learned in an econometrics class. Okay, and hopefully by this point, some of you would have figured out that there are some reasons to suspect that the birth date, the probability of being drawn into the lottery pool based on your birth date is exogenous, because as long as there is some possibility that your birthday makes you eligible for the lottery, you're going to have uncertainty about your future, and of course that's going to cause some change in behavior. That would be one concern. And anytime you're drawn into being potentially eligible for military service, there's going to be a behavioral change in terms of the schooling you receive, right? So those would be the classical arguments for why the lottery variable is not truly exogenous. Okay? But even putting aside those concerns, and if we just accept that being assigned into the lottery pool is exogenous, well, we can accept that whenever there's an assignment into serving into the military, there's going to be an effect. But what can we say about the causal mechanism here, right? And there's a number of different explanations. One explanation is that when employers are looking to hire people, they want to hire people with civilian experience rather than military experience. It could also be the case that serving in the military reduces your schooling, and of course that's going to have an effect on future earnings. And military service, you could come up with a theory for why there would be some kind of traumatic psychological, physical effects, which again reduces productivity in the future, right? So definitely the case that you can show causation with a truly random assignment, but understanding the true economic mechanism is what's interesting to an academic, and it's also what's interesting if you were someone who was setting the policy, for example, and considering sort of the returns to schooling and the returns to different types of experience. And for those of you interested, I can give you some resources that could show you that even if you control for some of these other variables like schooling and like psychological effects, you would still not have a true exogenous instrument that would give you the underlying mechanism of this causal relationship. Okay? So this would be sort of the drawbacks of doing descriptive work. And before I move on to structural modeling, I want to just briefly talk about how we can do well at doing descriptive research. Okay? So kind of based on my understanding, doing descriptive work really well, and that's really informative to the users, is a little bit of a lost art. Okay, so generally what you want to do for the reader is to highlight sort of all the richness that you have in the data set. Okay, so in order to do that, it seems to me that we need to be as flexible as possible when it comes to our statistical specifications. So rather than sort of taking the low-hanging fruit and taking all your data and throwing it into some sort of regression or even some sort of correlation table, I think it's actually really nice for the reader to see some graphs of how certain variables relate to one another, even some joint densities. You can plot that in most software programs. So definitely graphs and sort of non-parametric regressions are going to really highlight to the users and help them explore the interesting parts of your data set to the extent there's non-linearity between sort of the x's and y's that you pick out in the data set. Okay. Of course, when you have a data set with many variables, the dimensionality problem is going to be a concern because you cannot realistically do non-parametric work with sort of a large number of variables. You just don't have enough data to be so rich. So even there, I would say that instead of just taking the low-hanging fruit and dumping everything into a regression, what you could still do is just produce more and more tables and charts to highlight to the user, right? So if you have 3 variables that you cannot plot completely non-parametrically, you could, of course, just sort the data into deciles and quintiles based on one variable, and then for each quintile perform some sort of non-parametric density analysis for the those other two variables. Similarly, if you were concerned about what is common and what is heterogeneous across different industries or different years, you could still just run only a fixed effects regression up front, take the residuals, and then plot the rest non-parametrically to show us sort of the nonlinearities that might be notable for both a theorist and an empiricist. So with that, let's talk about sort of how I learned structural work and what it truly means. Okay? So when we are doing structural modeling, we have to develop an explicit model based on some economic theory. And that model not only has to be based in theory, it also has to give us a prediction about the joint density of the variables we see in the data. Okay? So as you can see, structural modeling then has two components which kind of marry sort of the theory research and the empirical research that you've gotten training on. Okay? So the first piece, of course, is that you have to have some theory. And then when I say theory, I mean something that is formal, that is written down as a mathematical expression instead of just sort of verbalizations, right? So when it comes to some of these microeconomic constructs, we want to be very precise about the relationships that we want to capture in the underlying setting. Okay? Some examples about what you could incorporate in this theory has to do with preferences or objective functions, discount rates, risk aversions. Those are sort of the objects that we learn that are the basic building blocks for all of the microeconomic theory we learn. Okay? So that's the theory component. And of course, rarely is the case that you get to observe everything that you see in the theory model. And it's rarely the case that everything you see in the theory model will fit the data completely. So recognizing this concern, we're of course going to have to make some assumptions about the statistical distributions in order to do a comparison to the data. Okay? So this is the complete definition of how I think about structural modeling. Notice what is not there. Okay? There's nothing in the definition that says we cannot include some sort of random assignment, some quasi-natural experiment or natural experiment into a structural model. And in the last session of the day, I will give you some examples of how researchers have been able to successfully marry both of their approaches. Okay? So before we talk about why you want to do structural work, I've put up a list of reasons why you wouldn't want to do it. So certainly I've heard these as reasons in workshops that I've sat in as an audience, but in all honesty, I've also used some of those reasons myself. So even though those are supposed to be tongue-in-cheek, I just want to make sure that we sort of have the right motivations for why we want to do structural work. And certainly, if you're the referee on a structural paper, you want to look for a front end that is not based on any of those reasons. Okay? The misguided or the misconceptions about structural work is that it's something fancy that I know about that you don't, and that's what makes me better. I hope at this stage in this literature that notion has not spread widely yet, and I hope that none of you will play a role in spreading that notion. Okay? So if these are reasons not to pursue structural work, here's a list of the sort of advantages of why we would want to do structural modeling. Okay? This is why you want the audience to be engaged in your structural model. Okay? So because we are taking an explicit mathematical theory very literally, then we can very literally tell the audience about some sort of underlying microeconomic parameter. So we can give them a quantification of something in the objective function, something about preferences, risk aversion, all of those alike. And because these are microeconomic primitives, then it would be interesting to also tell the reader or the audience something about a counterfactual prediction. What is a counterfactual prediction? We are giving the reader a numerical forecast of what we would see in the outcome variable once we turn the dial on the underlying economic primitives. Right? And because we have tied the data directly to an economic primitive, then of course we can make suggestions that would be useful for policymakers and for regulators. Okay? You will also find that with structural models, there are sometimes objects that are unobserved that you are never going to recover with a more descriptive model. Okay? It's only by overlaying a theory on top of the data you see that you can get to something that the researcher cannot observe. And of course, a last motivation that you want to think about when doing structural work is you could be testing a theory, and that theory gets linked very close to the data. So you can make a very precise statement about what is and isn't good about the theory, and you can also make a precise statement about which of the theories work better to the extent that you are positing competing theories. Any questions? Okay. All right, everyone seems a little shy. All right, what do we have?
I know nothing about structural modeling, but my question is, so given what you said, then you have a model, you have a set of data, you bring the data through to model, bring the model to the data, and you see it's a good fit. But that's like your sample, and then you have like counterfactual predictions based on the set of data and model that you have. How confident are we in terms of the counterfactual prediction that we have with sort of out-of-sample prediction, and how do we get a sense of the confidence that we should put into those kind of predictions?
That's an excellent question. So to my knowledge, there would be two ways to address that concern. The first way is, of course, is you perform your structural estimation using only a part of the sample, and then you save some observations aside where essentially the estimates you're recovering is independent of what you've set aside. Of course, then once you get those estimates, you can use that to make a prediction about the outcome you would see in the sample you've set aside and assess the ability to predict. So that would be the typical conventional one that I see. In certain settings, and if you get lucky, you might be able to make a counterfactual prediction about something that is actually observed in the real life institution. So again, in the last session, I will sort of show you examples of counterfactual predictions that researchers were actually able to test by conducting a real field experiment, or they were able to test by looking at what is mostly a quasi-natural experiment. So kind of, I think that finding a truly natural experiment is something that a lot of researchers need luck, right? So if you are lucky to find one of those settings, then it's definitely worthwhile to overlay that data with some sort of structural model so that you're taking advantages of the best aspects of both types of research. Okay? Sure.
So is there a certain, so in terms of choosing between the conventional of reduced form versus structural, is there a difference in terms of the number of observations that you require for structural versus
So I would say if you hold, so the difference between those two approaches is the restrictiveness of the assumptions you're overlaying on the data. And as you overlay more assumptions, that's going to require more data. So kind of that's just a statistical fact. Of course, sort of the whether or not you want to impose more assumptions has to do with sort of what you get from those assumptions versus what you give up. So I would say holding constant the assumption you make, you don't need more or less data for the both approaches. Yes, Sharon.
Other than the difficulties with process, is there other disadvantages of using structural models?
Okay, well that's a good segue into the common critiques, right? Okay, so these are critiques you hear in the referee process and also in a lot of workshops. Okay? So of course, the most common one is that you're making too many assumptions. And I would actually place a little bit more nuance on that objection because first of all, you should probe further with the person who's being skeptical. Are they being skeptical about the statistical assumptions you made, or are they being skeptical about sort of the microeconomic assumptions you made? So with the statistical assumptions, it's actually a little bit easier to address that concern because as we know, sort of to do any empirical work, we need to place statistical restrictions, right? So normality assumptions are very typical, and that's just for analytical convenience, and that is something that we cannot test fundamentally. The one that is more common, and the one that I think depending on who asks you that question has more validity, has to do with the assumption about the fundamental microeconomic setting. So the way that objection is typically worded to me is someone will put up their hand in the audience and say, "Oh, but Yofei, you don't know what I know about the actual underlying economic setting. There's so many considerations that the analysts or other economic agent are taking into account when coming up with what they forecast or other choices they make. And it's not nearly possible to try to capture all of that into theory. And if you're taking existing theory to use in your structural modeling, well, that's just supposed to be a stylized version for making predictions. You don't want to be literally taking that to the data." Okay, so I would say that if you attempt structural work, almost all of you will face this objection in some form. Okay, so my response would take one of the following forms, right? So it is true that especially in accounting, the real world institutions are very complex and very hard to be complete when capturing all of them. Having said that, I think it's a worthwhile exercise to ask ourselves, what if we made an attempt to capture that setting? And if in that attempt we manage to explain the data in one aspect, then it is something in the right direction, and maybe the next researcher can come along and incorporate something a little bit more about that setting. Okay, so basically my response would be yes, it's a hard exercise, maybe a harder exercise than what you see in other disciplines, but you definitely want to give it a try. And since you are the first one to give it a try, hopefully, then as a starting step, why not just consider one critical feature of that economic setting? Okay? And ideally, you want to be able to convince your reader that you have done a good job at explaining one feature of the data. It could be the case that as you add in more features of the setting, that you find yourself not being able to explain other aspects of the data. But at the end of the day, you want to go one step at a time in terms of theory, and then one step at a time in terms of what joint densities and conditional expectations you want to study in the data. Okay. The second critique I see has to do with, with quote unquote reduced form work, which I call descriptive work here, there's no control variables, right? All you're showing me is like 1 or 2 parameter estimates, and I can't really tie it back to sort of a reduced form sort of setting. And the concern here, again, is something that I would want to probe the reader about. So let's think about what we do when we are doing descriptive work and trying to test a theory or infer causation. Why is it that we throw in all these control variables? And the first one is the most important one, and it's the correlated emitted variable problem, right? So when we regress y on x and want to interpret the coefficient as the causal effect of x on y, then we want to be concerned about all of these z variables here, which could be correlated with the outcome variable outside of its correlation with the treatment variable, right? So kind of that's the problem that all of you would have studied in your econometrics class. And I would say this is where a structural model shines, right? So I don't know of any deep sort of economic models where the effect is your studying gives rise to a prediction that would look the same as the prediction you would get from studying another variable. Okay, so if you think about sort of the reduced form, the descriptive work out there used to establish causation, it's very easy to identify a set of z's out there which could be simultaneously correlated with the y variable you're interested in, but also the epsilon. Right, kind of, those are the ones that in a workshop setting you typically get objections about, and then because of that concern, you have to throw it in as a control. Okay, to my knowledge, when it comes to structural models, if you sit down and write down the actual economic relationship, what the model predicts about how y should vary with x should be pretty unique. And so in the workshop, when you get the comment about why you aren't throwing controls, you would answer something along the lines of, well, it is a concern that z could also matter in this outcome variable, but if I try to model what z does to this y variable, you would see an equilibrium prediction or some sort of optimization problem that cannot look like what I've recovered in terms of the equilibrium relationship between y and x. Okay? So that one is a little bit easier to answer. And of course, you could also just say that it's very good concern to think about these other covariates, but also as a first step, I'm trying to capture this one feature of the setting. And again, the setting, that x variable should explain y fairly well.
I'm sorry, can you just explain that point again? That if somebody says you have a correlated variable, you're using size.
Yes.
And so that should go into your estimation, or that should go into your model, and then your response?
So I'm saying that if the concern is that it's size that's also driving this particular phenomenon, then if you incorporate size into that economic model, you should not see the same equilibrium prediction about why the outcome variable and size as you would between what variable you're interested in. Okay. Of course, I think this is a little bit of an easy way out, because what you're doing is you're essentially on the spot demanding the person who is questioning you to come up with a model about how size relates to the outcome variable, right? And that is the thought experiment that we do all need to go through. And the onus is, of course, is on the person who's skeptical to come up with that model. Okay, so that's just, it doesn't always work, right? The other theme that comes out of this concern is that sometimes researchers are just used to seeing a regression table, right? And they are used to seeing all these covariates being thrown in. And maybe sort of the different way they express this concern is that how are you capturing the cross-sectional heterogeneity in the units of observation? So these are things like size, industry composition, book to market, sort of all of the fundamental things that you can calculate out of CompuStat. And I would have to admit that this is a concern that I haven't been able to totally address, and that's something I'm still trying to refine. But I would say that in principle, all structural models should be able to accommodate the same kitchen sink of controls that you see with descriptive regression. Okay, so if you see industry fixed effects, random effects, time fixed effects, firm fixed effects even, you should be able to incorporate that into the structural models. In practice though, doing that is very computationally intensive. Oftentimes, computing one or two parameters is pretty difficult already. Trying to compute it for every single firm out there in CompuStat just becomes not a very feasible task. So my suggestion for addressing this kind of concern is just, of course, layer on one type of heterogeneity at a time. So a lot of structural modeling researchers will do their estimation on an industry-only basis, and that helps to address some of these concerns. Ideally, as you layer on the heterogeneity, you should hopefully find that your parameter estimates are not too sensitive to those heterogeneity, and of course, then you can make a statement about how increasing the heterogeneity would not matter. Yes.
When you're saying like the layer on the variables, are you basically saying like instead of having like one parameters for all industries, I'm just gonna try to make like 10 parameters?
Yes.
10,
Yes. Yes. That's the idea of heterogeneity. Yeah.
Do you have any because it's pretty easy, impossible to actually find, because there will be so many parameters that it's completely different.
Do I have an example of?
Yeah, so do you have an example of the way to, because the way that it works, like you do this effect
Yes.
in the traditional regression, which is kind of like, remove from the data
Yeah.
what the variation that you
Yes.
want.
Uh-huh.
So that you're aware of it, where you would remove these variations before you apply your simpler structure estimation.
So when we do descriptive work, we allow for or different averages for every firm or every dimension that's similar. We could do the same thing with parameters. So if we're looking at one of the examples I'm going to talk about is the causal effect of equity incentives on earning manipulation. And of course, the incentive for earnings manipulation depends on cost. We could conceptually allow that cost to vary depending on the characteristics of the particular board we're looking at. Okay. So when it comes to identifying heterogeneity, I think in practice, in most of the settings I've seen, by the time you impose so much structure on the data so that you can recover the economic parameter of interest, it generally becomes harder to actually identify heterogeneity. So as you layer on different types of fixed effects, for example, or different types of control variables, you will find that your parameter estimates become less and less insensitive, and that's one way to convince your audience that perhaps you've captured a sufficient degree of heterogeneity. Yes, Sharon.
Usually in theory models, what's the added variable? Because this is the way of controlling for the added model. Because these variables outside of the model. But with the in the data, you put them in control, and is this similar to something with the model, even with the
I'm not sure exactly sort of this, what notion you're getting at. Let's kind of defer sort of the thorough response to that question after I do my example or after I cover some of these examples, and then we can sort of come back to exactly kind of what the distinction you are referring to. Okay. So before I go to the examples, the last critique I want to go over is, of course, sort of the gruffy old senior faculty. Hopefully I'm not offending anyone here. Okay. Who puts up a hand and says, how am I supposed to believe you? All this is from this black box of fancy technique you put out, right? So this would be the one critique where I would say if you've given your audience, even that gruffy old senior faculty, that impression, then sort of you need to think about rewriting your presentation and rewriting your paper. Okay? When it comes to structural work, more parameters, more moment conditions, more of anything technical is not necessarily better. Okay? So in terms of presenting this to the audience, when you talk about sort of how you're identifying parameters, that's essentially kind of what the skeptics are going after you for. You want to be able to explain it to them with words and pictures rather than equations, right? And you want to give them statements like, well, if this part of my theory is true, then as I adjust this microeconomic parameter, I should be able to see this plot or this association in the data that I would not see if I adjust another parameter. Okay, so kind of, it's not easy actually to be able to explain this words. It actually turns out it's easy to do this with equations. Okay? So in the last few minutes, I'm going to go over some of the earlier and more recent works in terms of structural modeling in accounting and capital markets in general. This is not supposed to be a complete list of papers that I really admire. And definitely Yvonne covered some papers with you this morning. Jeremy and Frank will cover some of their own work tomorrow. But these are just papers I picked out where I have a good appreciation for, and I can succinctly explain why they ticked off some of these check boxes you saw here and how they were able to address some of the critiques that you saw on these later slides. Okay, so the first one I'm going to talk about is probably sort of the OG structural model in corporate finance. And that paper was motivated by something that we observe in the data generally, right? It turns out that CEOs are not fired frequently. For those of you familiar with like the Bebchuk and Fried type of commentary, they assert that this infrequency of CEO turnover is due to managerial entrenchment. And sort of there's also all these policy considerations, right? So, well, what this paper did is it wrote down a model of CEO hiring and firing decisions, and it included some of the common factors that we've hypothesized as leading to CEO retention that's been discussed in previous literature. Okay? So some of the common factors are like entrenchment with the board, difficulty with learning about the CEO ability, the fact that CEO ability might not matter a lot, and the high switching costs, right? So why is this problem suitable for doing structural modeling? Okay? We have these competing explanations, and it's hard to find a setting where we can turn the dial on all four of these factors at once. And of course, all four of them would be exogenous, right? So it's almost impossible. So that would be one reason we are testing a theory or competing theory. Okay? So what this model was able to do is come up with parameters capturing some of those economic forces that we talked about entrenchment, about learning, and about switching costs. And because those models are like an economic primitive, we can of course turn the dial, right? So if we accept that CEOs don't get fired because they're in cahoots with the board, can we make a prediction about what would happen once we make the board less entrenched with the manager? Okay? You can kind of find natural experiments for this, but fundamentally the level of entrenchment with the board is unobserved. So as a result, the structural model is something that is very suited for this exercise. Okay? So, and as you can see at the end of the day, with this set of parameters that he estimated, he's able to make a prediction about how much dollar amount of profitability you will be able to observe across firms if you were to turn the dial on the board governance. And from a regulator's perspective, of course, the understanding the dollar impact of governance is going to be interesting and impactful. Okay? So structural modeling, very well suited for this type of question because it is helping us understand the different mechanisms that would give rise to the behavior we see. Okay? One last thing I wanted to point out about this paper is that when it comes to the identification strategy, it relies on words and not on kind of mathematical expression, right? So if you go into the paper, you will see that he talks about when you turn the dial on each of these four components, they should have different implications about the actual turnover you see relative to the profitability, so the actual CEO performance during the turnover, as well as the differences in the cross-sectional differences in CEO skills. Okay, so he's essentially saying that turning the dial on one component is going to give you differences in one of those distributions that you would not see when you turn the dial other parameters. And that's essentially a good way to convince the user that this is not a black box and there is some intuition going behind how you're identifying the economic parameters. Okay. Second structural model I want to talk about is motivated by this long hypothesized theory, and also seems to be supported by the descriptive evidence. And the descriptive evidence says that CEOs with high-powered incentives tend to engage in more earnings manipulation. So what Nastia did in her dissertation was, of course, write down exactly what the CEO is after when coming up with their earnings report. And over multiple periods, of course, the CEO has to trade off misreporting in their earnings and the cost of misreporting through perhaps being fired and the like. And by estimating this model, she was able to come up with predictions about restatements that perform better at predicting than some of the other models. So like it does better than the modified Jones type of models where we just project accruals onto normal accruals and take the leftover piece. Okay? Turns out that when you actually describe out the CEO's behavior, then the model is going to generate some statements about misreporting that performs better. Okay? What this model also does very well at is telling you what is not observed, right? We know, even if we take for a fact that there is earnings manipulation, past literature has not given us a very satisfying amount about the dollar amount of that manipulation. And this paper actually is able to quantify that amount in terms of the market cap of the stock exchange, for example. Okay? So, and of course, the last contribution of this paper is making predictions about behavior under a different setting, right? A setting that we would not able to observe. So for example, if the SEC increases enforcement efforts, what kind of differences in misreporting would we be able to see? Again, that would be something that the policymakers should be highly interested in. So just to put this into the big picture of what structural work buys you versus descriptive work, well, what do we know about descriptive work? Even with truly random assignment, with something that is completely exogenous, the only thing we can conclude is that whenever you change CEO incentives, there's a causal relationship on their corresponding misreporting. Okay? What's nice here is that with a structural model, we can be very explicit about exactly what it is in the CEO's incentive environment which would give rise to the manipulation we see. And because we understand that incentive environment in numerical form, then of course we could tell the user, once we make a different numerical incentive environment, we would see a different type of behavior. Okay. Moving on, right? So here's another paper which I think sort of illustrates the advantages of structural modeling. And this has to do with interest rate forecast. Right? So most of you have heard back a couple years ago, there was a big scandal with the major banks in England misreporting their estimate, their forecasts of LIBOR, right? So essentially, they were supposed to tell the public what they think is their estimate of the cost of borrowing, but as it turns out, they don't seem to be reporting truthfully. And again, the policymakers would be very concerned about this phenomenon. Okay? So what Pietro did in his dissertation was to write down a model that incorporates what banks are interested in when they decide on the LIBOR that they report. Okay? And based on his knowledge, so I think he has some experience working in banking, and based on that institution knowledge, he's identified sort of two primary economic forces. First one is what he calls exposure, right? So that's this notion that if I'm a bank that is borrowing, I want to borrow for cheaper. So I want to make LIBOR smaller. The other hand, if I'm lending, then I want to have higher return on the use of my capital. Okay, so that would be consideration number one. Consideration number two has to do with signaling. Okay? And that's this notion that in addition to what banks want to do in terms of lending and borrowing, they also want to convince the market that they are creditworthy. Okay, so the first concern would lead them to either bias upwards and downwards, depending on sort of what their exposure is. Second concern would probably to report a lower rate. Okay? So by taking sort of this objective function and estimating it in the data, he's actually able to tell us something about the true distribution of what banks believe is their borrowing costs versus what we can only see in the data is what's being reported as LIBOR. Okay? And quickly before we go to break, I think that Pietro has done a nice job of illustrating the identification strategy here, right? So the primary purpose of doing a structural model here is to distinguish the exposure part of the bank's objective function from the signaling part. Okay? It turns out that if the bank is only concerned about exposure, then they are just interested in shifting up or down their forecast just by a linear constant amount. Okay? So in those cases, that would be the difference between, in the left plot, between the solid black dots you see and the grayed out black dots. Okay, so as you turn the dial on this exposure incentive, you would turn the dial on how much bias upwards and down. But of course, the bias is going to be constant. It's going to be a constant shift. The red line, of course, is the truthful reporting line. Okay? Having said that, this second explanation, signaling, has a different implication because it turns out that when LIBOR is aggregated, what the central authority does is they truncate the different forecasts from different banks on the extremes. Okay? So that's going to be interesting for the signaling explanation because if they were just interested in lowering the LIBOR at the end altogether, then there are a lot of different types of borrowing costs where biasing a little bit does not affect their ability to change LIBOR at all. Okay? And it turns out that at the threshold in which your LIBOR forecasts matter for the overall LIBOR report, while there's going to be a discrete jump in the optimal forecast you will report. And because there's this nonlinearity in your optimal forecast due to the signaling motivation, then it means that when we observe multiple banks and we look at the cross-section of the distribution, the signaling explanation should give a different prediction relative to the exposure prediction. If the exposure prediction is supposed to give a constant transformation, then all you should see is the same normally distributed distribution of reports shifted with the mean, with a different mean. Having said that, under the signaling explanation, of course, you're going to see an asymmetry between the different banks reporting, and you should see a different left tail and right tail. And of course, when you see this asymmetry, there should be a difference in the mean and the median of the distribution. Pietro probably would not be very happy with the way I've explained it, but what is giving rise to his identification strategy is the difference between the mean and the median of the distribution of LIBOR forecasts that he observes. Okay? I would just add one caveat that Pietro's contribution, in addition to being able to tell the user something about the unobserved distribution of borrowing costs, is that he's developed some techniques for identification in this setting with very little data. So if you try to read through some of his paper, it's very technical and it requires some understanding of the empirical auctions literature. Nevertheless, I think the way he's described the identification strategies. All right, so before the break, I talked about Pietro's paper, which was sort of more on the technical side. What I like about this paper is it's on the opposite extreme in terms of the amount of technical details, but I still, at the end of the day, it does a very nice job of illustrating the identification strategy, and it does a nice job of addressing an important question. Okay, so why is it an important question? Well, what has descriptive work been able to tell us about the earnings return relationship? Okay? It's something that we've been working on in the accounting profession for decades now. And for decades, we've known this result that earnings exhibit a different sensitivity in response to different types of past returns, right? So that's basically the Basu 1997 landmark paper. Again, super helpful descriptive result. Of course, sort of in the time since then, we've spent a lot of work trying to understand this phenomenon further. And one of the strongest pieces of theory that's been used to explain this result is, of course, conservatism, right? So that's this notion that when it comes to the accounting measurement system, we come up with rules such that accounting information picks up quote-unquote negative earnings news quicker than positive earnings news. Okay, so descriptive fact that's certainly interesting, but I would argue that Mateus and David's paper took a big leap in terms of testing this theory. Why is that? Okay, so the paper is taking the perspective that if we assume that accounting is completely neutral and doesn't differentiate between what is a good and bad profitability shock, what kind of pattern will we see in the data in terms of the earnings return relationship? Okay, so what they were able to do is to use a pre-existing model about how capital evolves, how investment evolves, and how profitability evolves. And using that model, they were able to plot out what the predicted level of earnings are as a function of returns. And as you can see, even if we scale back the setting to only its basic features, just investment and capital levels and profitability shocks every period, and you incorporate one additional assumption about the adjustment cost of investing in capital, which I understand is pretty common in the macro literature, then it turns out you are able to produce this non-linearity between how earnings reflects returns. Okay, I'm not going to be able to explain it as well as Matthias or David, but basically what the model is pointing out is that returns and earnings are both endogenously determined based on the investment level. And because there's going to be convexity in the adjustment costs of making investments, it's going to give rise to different sensitivities in how earnings behave in response to profitability shocks in relation to returns. And it's this difference in sensitivities that's giving rise to the prediction about the nonlinearities in the ERC regression. Okay, so first off, I just think when it comes to illustrating theoretical intuition, sort of the more you can do, the better. Even though sort of you're doing an empirical exercise, it always helps to add some interpretation, some words to the comparative statistics that you're seeing. Okay? What I think the strongest piece of this paper is what they do to address the common critique that you will see out there about doing structural work. And that's the form, the results you get is not something that looks like a linear regression, so therefore I don't know what to do with the results. Okay? So recognizing this concern, what Matthias and David did was they used their model to generate some data. And using the data generated for the model, they ran a regression of these two endogenous variables from the model. Okay? And when they do this exercise using just the model, they're able to incorporate every kind of econometric tool that you see from descriptive study. So if you want fixed effects, those are there. Standard errors, those are there. Double clustered standard errors, they incorporate that as well. And they kind of do almost everything up to a T as you would do when running this BASU type of regression. Okay? So that's everything that the model is trying to tell them. And of course, they can do the same thing using actual data. Okay? And what do they find? Well, this model is actually pretty good at coming up with the regressions that you see in the data. So the punchline here is that even without adding on conservative properties into the accounting measurement system, just having convexity in terms of the adjustment costs to making investments, you would expect to see this non-linearity in the ERC regression. Question?
Did they use the Basque coefficients as their moments?
No, my understanding is that this paper did not even go as far as matching up any moments at all. All it did is generate numerical facts from the model, and they compared it to the data.
So you generated numerical facts from the data just on simulations?
Yeah, so my guess is that behind the scenes they might have tried to match up some moments. But as far as the way they've written the paper, they just told us that they did some calibration with the parameters, and through that calibration exercise, they were able to generate these facts for the model, which line up with the data. I would suspect that the calibration is a little bit of an understatement in terms of how sophisticated their work had to be, because you would have to be really lucky to just be able to ad hoc pick numbers that would get you this close. Okay. But is it Andreas?
Andrew.
Yeah, Andrew, okay. You do bring up a good insight here is that structural models do not have to be about matching up moments, do not have to be about estimation at all, right? So do they have a formal theoretical model here? They do. And do they have a stochastic specification that allows them to compare it to the observed data? Yes, they do. And that's what satisfies as a structural approach. And what I think this paper where it has potential is that it does not rule out conservative accounting, right? All it says is that I can write a model without conservatism and add in one extra feature, and that one extra feature would be something that generates identical data as this conservatism explanation. Okay, so certainly nothing in here is going to discredit any of the work that we've done over decades and decades about conservatism altogether. But of course, what would be the natural next step based on this paper? Well, to write down their model, but include this notion of conservatism. Okay? So to do that, of course, you need to have some theoretical skills in terms of modeling and solving for optimal solutions here. But you also need to be able to recognize that because you're trying to identify one extra component of this model, you need to observe something else in the data to be able to disentangle conservatism. Okay, so finding that extra source of variation in the data to disentangle between adjustment costs and conservatism is what I would consider the identification exercise in a structural setting, and that identification exercise is much harder than just statistically looking for the parameters. Okay? So you can definitely see that there when we write out this richer model, we can make a lot of interesting inferences. Of course, actually being able to take pen and paper and put all of those components into mathematical expressions, that would be the challenging part. Right? So the bottom line here is that hopefully, by looking at examples of all these papers, one common theme is not that they use fancy econometric techniques or sort of GMM, simulated GMM, and any of the later tools that have come along. So it can go from one extreme to the other extreme in terms of sophistication. But what I see is similar across all these papers is that prior research has identified a descriptive fact that we see in the data, and that has given rise to an interesting question. And these structural papers have been able to answer the questions in a way that you can simply not address with a descriptive approach. Okay. So to conclude sort of this portion of my presentation, I would say that there are a lot of different phenomenon and empirical facts that we have not yet explored with structural approaches. Examples I've thought of have to do with corporate governance and contracting. Also, this whole notion of the proprietary costs of disclosure, right? So there's a wealth of different places where we can take theory literally and apply it to the data. Just to give you a little bit of a background, sort of, I used to be like a very traditional accountant. So when I was working in the Big Four, I was the one writing memos about sort of accounting standards, how to clarify the guidance on revenue recognition and the like. So earlier in my PhD career, I was really interested in those standard setting type of issues. So this is sort of on my bucket list is to come up with a structural model for accounting standards that would also allow for room for this notion of enforcement and institutions and regulation, right? So it's something that I think would be ideal for exploring in a structural setting. When we try to get the audience to buy in about a structural model, there will be a lot of skepticism, mainly having to do with assumptions, having to do with your techniques. So hopefully I've given you sort of some good responses to that skepticism. But having said that, once you convince the audience that you need to address that particular question you're asking with a structural model, sort of the bar that they will apply in terms of how well you calculate standard errors, how convincingly you've shown consistency and rates of convergence and whatnot, I don't think will be particularly onerous. And so that is the upside here. And of course, I'm just going to end by saying that you should emphasize why the particular question you're asking is important. And when it comes to details of how you did the estimation, how you calculated the standard error, how clever your approach was to getting your estimation to converge quicker than previous methods, I'm sure that's what you spent a lot of effort on, but that's not what the audience is interested in. So I encourage you to bury those descriptions way in the back of the paper, preferably in an appendix, preferably in an online appendix. Okay? So before I go, those are the exact words my advisor gave to me. I like to think that deep in his heart, he really appreciated my sophisticated methods, but he certainly did not show it. Before I move on, just want to acknowledge that sort of when it comes to how I think about structural work, of course, the principles and my philosophy is very much shaped by my advisors at Stanford. So kind of if you want to go to sort of the original source of this philosophy, I encourage you to look through some of the slides and light reading from some of these papers. They're not very heavy, and they're not the ones that you typically think of when it comes to the basics of structural work. So good beach time reading for after the session is over. Okay? With that, I'm going to go to the next portion of my talk, which is about how to do it on a hands-on level. So I just want to give you a sense of what my goal here is. Rather than giving you a completed structural paper that I've done and show you sort of the end result and the full code that's 50 files long, I thought I would sort of scale it back a little. Okay? And why is that? Well, first of all, I know like even if I give you a full structural paper of mine, you probably won't read it in its detail, and you probably won't go into the code to try to understand every line in its full detail. Okay? And moreover, I think for every PhD student, there's a critical inflection point in terms of the development of their thesis. And for me, my inflection point in terms of when I knew I was going to have something to present and when I knew I could confidently sell my dissertation to the job market came maybe, I would say, sort of May of my 4th year. Okay, so I finished in 5 years, went on the job market in my 5th year. So for most of you, that should come off as a little late, right? So what it is that it took me probably 2 years of just learning what structural work is, so sort of the first hour of this presentation you saw, and sort of what forms the backbone of a good structural project. Okay? And in that process, there was a lot of contentious discussion with my advisors, and then going back and forth with sort of the different faculty who held different views about this type of work. Okay? And what I was doing sort of in my 3rd year and even in my 2nd year of my PhD program, I knew I wanted to do structural work for sure, but what I was doing is just going right to the estimation, because that's what I learned in class, right? When you go to a econ class covering structural estimation, you typically see the GMM procedure. Those are the moments, these are the parameters, this is the test of the identifying restrictions, and voila, that's the paper. But of course, when I tried to do that, I just often got overwhelmed by how much theory I had to write down. And then even when I could write down theory, it was just hard to deal with the fact that there was so much stuff that was not observable in the model, and that I had to get it all down in terms of the estimation procedure. Okay? So what I'm going to try to do is show you how to start a structural project and get it as far as sort of the main critical table that you can present. I said that sort of it took me 2 years to get that point. Hopefully I can show you how to get there in an hour and save you and your advisors a lot of tears and just go sort of acrimonious meetings. Okay, so what I'm going to emphasize here is that when starting out the structural model, don't get too ambitious. Start with something that is really, really simple in terms of your theory, and look for what is the minimum thing that you have to include in your theory in order to be able to identify something of interest in your data. Okay, and at this point, you don't want to be doing something too fancy in terms of constructing moment conditions, constructing distributions with the data yet. All you need to know is something about conditional expectations. So just graphs and histograms that are constructed cleverly in the data can be a good starting point. Okay? As far as estimation standard errors, that can be left until the very end. In my case, sort of the machine was still warm when it comes to estimating some of the standard errors by the time I was taking off for my first flight out interview, right? And kind of that is very typical. And at the end of the day, that's not something that's going to affect your ability to make the audience buy in about why this structural paper has a lot of impact. Okay? So what am I interested in here with my structural model? So I'm just going to give you sort of some of the behind the scenes of how I'm developing this idea. So I don't know if this will turn into a working paper yet. It's just something based on some papers I saw and some of the sketches I've done in terms of preliminary modeling attempts. Okay? So I think most of you yesterday would have gotten some presentations by Haresh, I believe, about the real effects literature, right? So hopefully I don't need to convince you that real effects is important, and I've only sort of selectively listed out the prior evidence, but basically when you survey CEOs, they tell you that short-term incentives lead them to distort investment, and there are some empirical papers illustrating this notion of real effects. So basically, when CEOs have short-term incentives, they tend to underinvest, and as you can imagine, regulators would have concerns about this phenomenon as well. And at this point, I'm just going to embarrass our Duke PhD student, Eric. So my motivation for sketching out this project came from his summer paper presentation. And when he came to my office, I told him, boy, this would be an exciting topic to model with the structural approach. So to give him full credit, I'll talk about at the end how to incorporate sort of the methodology he took into a structural type of setting. Okay? So why is this something that we need to explore from using a structural approach? Well, by definition, this is something where a certain feature of the economic setting gives rise to distortions in behavior. Okay, so that is one of the checklists you should think about in terms of looking for structural topic. This is also a good topic because when David from the Breuer and Windischish paper that I presented earlier came to give his talk on his model, I realized that there's already a big tool set for modeling what optimal investment decisions should be. Okay? And those are not very intimidating in terms of solving and in terms of sort of the mathematical technology involved. And of course, in data, it's really easy to grab measures of investment, right? So don't need to do anything fancy. Everything from CompuStat is effective there. Okay? And of course, like I said already, with a structural approach, you can make statements about incentives causing changes in behavior, but of course, you can quantify the exact dollar amount of change in behavior as a result of something in the incentive environment. And then once you do that quantification, you can make a counterfactual prediction of what would happen under a different incentive environment. Okay? So just to be a little bit more specific, I'm not an expert on the real effects literature by any means, but kind of one of the more impactful paper in this literature shows that a change in investment seems to be correlated with equity incentives once you control for the other confounding factors. And in this Edmonds-Pang and Llewellyn paper in I think it's RFS, they were able to come up with a very clever way to measure equity incentives that's basically seems to be exogenous to this particular specification here. So I won't go into too much detail here, but their conclusion is that CEOs are myopic, so they act like they are only concerned about short-term performance, and they seem to be foregoing positive NPV projects, right? So now that I know this is an empirical fact that's been well accepted in the literature, and now that I know that there's a model out there that tells me what investments should be, what I set out to do is ask myself, using this established model, can I generate this distortion in investments that you would expect to see when CEOs have short-run horizon? Okay. So the next couple of slides is going to go through the model, and I'm going to go through this in a little bit more detail than sort of what you would see in a normal presentation, just to show you sort of the different things that was going on in my head when considering the theoretical piece and the empirical piece down the line. Okay? So this model, which I'm adapting from finance, considers the cash flow each period. And the cash flow depends on the productivity. And then you have to make an investment every period. That's the IAT. And there's some adjustment cost, which is going to be convex. So that psi parameter captures the extent to which there's adjustment cost. Okay? And of course, it's standard in the literature to use theta to capture sort of the curvature in the production function. Of course, in each period, there's going to be a profitability factor, and that profitability factor is random, but of course, that profitability is serially correlated. So Z bar is going to capture the average profitability, and rho is going to pick up the persistence there. And of course, we have an error term. Okay? And each period, the payoff, of course, is going to depend on the capital stock. Okay? Capital stock is last year's capital stock, and then we apply depreciation, and then we're going to add the current period investment. Okay, so the IT is the flow variable, and K is the stock variable. I'm teaching accounts receivables to my master's students, and they kind of get this confused a lot. And as a result, I was getting these two confused a bit in my modeling as well. Okay. So what does the manager want to do? Well, if the manager's incentives are completely aligned with the shareholders, then they should be maximizing the discounted expected value of future cash flows. Okay? So just as the first call I have to make here, that discount rate, beta j, that I'm putting into the manager's maximization problem, it is almost always not identified in the data. That is a well-known phenomenon in economic research. That is something we're going to have to assume. So this is just a note that I make for myself in terms of starting to write my code. Okay? And then just to give you sort of a real-time blow recap of what I was thinking, right away, sort of this summation to infinity was something a bit intimidating for me. So at the time I wrote that equation, I asked myself, what do I do about that infinite sum here? And there's kind of I saw that there were two approaches. Number one is to just leave it as an infinite time horizon problem. And from there, what I would do is formulate the Bellman equation where next period states depends on this period states. There's a transition function, and then kind of you have to do something called value function iteration or potentially policy function iteration to arrive at the optimal investment policy. That is something I believe either Jeremy and/or Frank will cover with you next class. Okay? I have to admit that doing value function iteration is really, really hard, requires a lot of programming and debugging, and I got lazy. So what I did instead was I asked myself, can I simplify this into a finite time horizon and hope that as I increase the time periods that I analyze, it'll eventually converge to the infinite time problem. So this is an assumption that may make a theorist advisor cringe, but it is the one that I went with. By the way, it turns out the second approach was the easier one, and in hindsight, I wish I would have just taken the first one, right? Also, a note about taking the first approach, depending on sort of who your advisor is, who the audience you are presenting this to, they may get hung up on the existence of a solution to that Bellman equation altogether, right? So I believe you have to show that the Brouwer's fixed point theorem, there's some other fixed point theorems that you have to show that you've satisfied in order to be able to proceed with doing your value function iteration to start with. I believe in this case, I can maybe hand wave and show that I've satisfied it, but kind of you may not get away with sort of the weaker theoretical arguments there. Okay. Good so far? So now that I've made this assumption that I'm just going to work with a finite time horizon problem, just for understanding sort of how to think about the economic forces here, what I did was start from the last period, write out some of the expressions for the cash flow, and do the same thing for the second last period. Okay? So what do I have in the last period? Well, in the last period, I'm not making any investments anymore. Instead, whatever capital stock I had in the previous period, that's going to give me a payoff. Okay? So there's no choice. There's no choice to be made at time t. Well, at time capital T minus 1, then I'm going to have to figure out how much investment to make because I'm trading off the investment, the cash flow of this period relative to the return next period, right? So so far, the algebra doesn't seem too tough. So I'm just, in that second line here, I'm writing out the cash flow for capital T minus 1. Okay? Now that I have the two cash flows, I can put it together and come up with the manager's optimization problem from the T minus 1 time period. Yes?
On the last slide, you said that you found that the finite time problem is the easier one.
Yes.
And it turns out the infinite time problem is the easier one. Now that you've realized that, is there a way that you could have known ex ante? Or
I was.
do you suggest generally going with the finite time horizon at the beginning?
It depends on. I would say the answer is it depends on how invested you are in doing this completely rigorously. So I would say that if you know up front that you want to do structural work, perhaps for this one paper and subsequent papers afterwards, then I would say being able to program out value function iteration is a good investment to make. And actually, I had a lot of code for doing value function iterations. I was just too lazy, or I didn't. Back 3 years ago, when I wrote out that code, I didn't put in enough comments for me to figure out what I wrote. So, I mean, there were a bunch of reasons. So, as I will talk about with sort of every step along the way here, how rigorous you want to be depends on sort of how invested you are into doing structural programming. So that would be my best answer. Okay. All right. That's the question. Okay. So I know I'm like still really far from my end result, right? So far, all I know is that the manager, if they only have one period left, well, in the second to last period, they have to solve an optimization problem. But just so that I understand the what the model looks like here, I can write out that optimization problem, and I can take a first order condition to figure out what the optimal level of investment would be. So when you combine CT and CT minus 1, and you put the discount factor in, and of course, when you are at T minus 1, Z at capital T, of course, is random, so you have expectation as well. What's nice about this is that at least when it comes to the last problem, I have an analytical expression for the condition. And that's going to help quite a bit. The problem is, of course, that when you look at this first order condition, you cannot solve for the optimal level of investment analytically. Okay? So Lack of ability to get an analytical closed form solution is not an issue. Why is that? We can always do a numerical solver. So at this point, we don't know what psi is, we don't know what beta is, we don't know what theta, what rho are, and we can just leave them as missing. But if you had values for all the parameters, and for a given level of profitability, and for a given capital stock K at t minus 1, then of course you can solve for I star t minus 1. So before moving on though, just wanted to give you some words of advice, words of caution about using numerical solvers. So notice here that even though I could always ask MATLAB or some other program to give me the optimal level of investment, you should always try to get an analytical characterization, okay? And that's going to make your life a lot easier down the line. In MATLAB, there's a couple of different solvers you could have used, sort of based on my research about solvers. F0 is the optimal one. The other ones you could have thought about, which is a little bit more general, are the roots function if you were dealing with a higher order polynomial. Okay? And finally, with any kind of numerical solver or numerical optimizer, you want to understand what the software is doing when trying to give you a solution. Okay? So here are some considerations you want to. So with F0, Fsolve, or MATLAB is to apply a certain algorithm. So typically, if the objective function is smooth, it's going to use some sort of Newton gradient-based algorithm. So the first determination you have to make is, of course, where you have the kind of objective function where that type pretty well. Okay. Other things you have to think about when it comes to sort of computational. If you set the tolerance really high, then you're of course going to have quicker convergence, but at a certain point you want to be concerned that the result you're getting is not very precise. You want to think about the starting values you use, because with all of these algorithms, you need to tell the software something about a guess. They need to other guesses. And step sizes, again, has to do with a nuance in terms of finding out the optimal solution. If the step size is too small, you may get stuck sort of at a local optimal and not be able to recover. Yes?
Talk a little bit about uniqueness.
Mm-hmm.
Observe values on the variables. Will these numerical algorithms tell you if the found solution is a
No. Unfortunately, that is not something that you can get MATLAB to do or any software to do for you. There are things that you can do in the software that can help you avoid the local optimal and go to the global one, but basically by using a more general search algorithm. So it's not going to satisfy theorists completely, but that's why you want to try to characterize the solution as much in closed form as possible. And because at least for this t-1 problem, I was able to characterize in closed form, then I can show uniqueness there. But that is just one of the drawbacks.
I'm getting confused as well.
Sure.
On two issues. One is solving for the parameters.
Oh, we're not there yet. We're not there yet. So just humor me and assume we know the parameters. Okay? Right now, we're just solving for the optimal investment, I star.
Gotcha.
Okay? Yeah. All right. So those were suggestions about how to use numerical solvers. And before I even go on to the more complicated problem of what happens in the t-2 period, I'm going to give you some suggestions to do with your. So I'm going to. So this is like real-time illustration of what I wrote up. So I'm going to show you what I wrote down initially to solve this optimization problem back here. All right, let's see. Laptop. So initially, what I did is I just went into MATLAB, wrote down, oh, okay, it's showing up there. Wrote down F0, which is MATLAB solver, and it's telling me that I need to solve for the investment level such that if I know beta, theta, z, and k, and the k at t minus 1, then I can find an optimal investment. I picked 0.5 as the starting value, okay? And that was just an arbitrary choice, okay? So this is the step I took because it was easy and it took me 5 seconds. This is not the optimal approach you take if you want to proceed in doing serious structural modeling. Some recommendations I have for you at each step along the way. Well, you compile it because even for this very simple step, if you have a bug, and as more steps, of course, you're never going to find the source of the bug. So I was not able to code this completely correctly on my first try. It took me like 5 tries to get that line of code correctly. So, but at least now that I know that line of code works, I can sort of add on additional layers. The second thing you want to think about is to make some of these things more general, right? So instead of writing it as an what's a good practice is to make every little step of your calculation a function. So instead of having this one big expression, a better approach is to break down the and then to solve for the optimal level of investment based on that. So really obvious at this point, but of course it's going to help you be more general as you proceed on with writing more code. Of course, while I'm making all of this stuff a function, why back where I had expressions for profitability and cash flows, even though those algebraic expressions are really simple, what I did is in MATLAB, I wrote them out as separate functions as well. Okay? And of course, if you wanted to be really general, you would move each of these functions into a separate, store them on your hard drive, and then you can call them cleanly each time you need them. And you would write sort of really helpful comments to yourself about what exactly is supposed to go in and what comes out of the functions. Okay? Some other best practices that you should do, but sort of even though I know they're best practices, sometimes I just can't find the discipline to do is to benchmark execution time. So in MATLAB, command would be tick and talk, and it's to see whether you can make even this simple calculation run even faster, right? So as you start layer on different guesses about parameters and different guesses about the i's and k's, then you're going to need to execute that piece of code 10 times, 100 times, even 1,000,000 times. So even if you can reduce the execution time of a single line of code by milliseconds, you are making a big improvement in terms of how fast you can execute the final stages of your code. At this point, you want to do some comparative statics about the model. So even for this T1 minus 1 case, you want to get some intuition for how the optimal investment policy varies with theta. So how the persistence parameter and how it varies with the adjustment cost parameters. And kind of be able to provide some theoretical intuition along the way in case you get asked later in your presentation. Okay. And then kind of some other suggestions are going to depend on how invested you are in doing structural work. If you think you're going to carry out this project to the end, i.e. Go actually estimate the underlying parameters and sort of write this up into a complete paper, you might want to start computing the I stars based on a range of values. Okay, so the computing time might become precious later on, and if you are able to get a rough idea of the optimal for reasonable values, then later on you can maybe make an approximation for the intermediate values and save yourself a lot of waiting when you really need results. Okay? Finally, kind of as most of you notice, the MATLAB is the one that I go to whenever I don't feel like spending a lot of time debugging. But of course, it's not going to be the best language to use if you want to be computationally efficient. So I already see Mario's disapproval here because, of course, we know that sort of some of the low-level languages will actually execute a lot faster. So I didn't follow all of the suggestions I listed here. So as you can see, I kept on using MATLAB. But the bottom line here is that you want to consider the trade-off, right? So if you want to program in C, for example, you know that the code will execute faster, but of course, you're going to have to invest a lot more time in writing out some of these routines, and then that investment might not be worth it should you decide that structural might not be the way to go. So before I go on to finally talking about the T-2 problem, I would say that after the T-1, solving the T-1 problem, that's the point in the research process where I thought seriously about really not having incremental contribution relative to other papers. Right? So the two papers I would be most concerned about is Steve Terry's paper and the Ling et al. 2018 paper. So both of these are roughly what I would call structural models of real effects. And this model would be a structural model of real effects. I would say that as a PhD student, sort of this is what gets at night. The good thing is with structural work, you have less risk of being scooped generally, right? If you're working with a natural experiment, you're always worried about someone else sort of using the same natural experiment and putting out the paper before you. So with the structural work, that risk is a little bit lower, but it is still there. And I would say that sort of after working on this for a couple of years, instead of panicking, I would generally say that the fact that other people are working on structural models of real effects is a good sign. And it's a good sign that you've landed on an important topic. Okay? And I don't have sort of a complete thought process on how to contrast this model with the other models yet, but here's some considerations I thought about, right? So in the Terry 2017 paper, there's an explicit role for earnings and then there's an explicit role for analyst forecasts, but those assumptions are imposed completely exogenously. And because they impose those assumptions, of course, they're able to make sort of counterfactual predictions about meeting or missing analyst forecasts. So definitely additional assumption, but it buys them some additional interesting inferences. I don't have too much macro training beyond sort of the undergrad macro 101. So when it comes to reading Steve's paper, which is essentially a macro model, I don't have a good sense of what we would get from writing down a micro model. So that is something I'm still working on. Most likely, I'm going to have to get tooled up in some of the macro techniques. And then if I consider the Liang et al. 2018 paper, there's some other differences that emerge. Okay. One feature is that they don't have any adjustment costs, but when they write down the manager's objective function, they impose sort of an exogenous incentive for only being concerned about the short-term price. And there's kind of a weighting between the terminal price and the short-term price in the objective function. They also seem to be using totally different parameters values to calibrate the model. So I'm going to need to spend some time understanding why the parameters values I'm using are so different. But I would say that even knowing that there's two competing papers, having sort of taken a preliminary look, I think there's still a role for this model to inform future research. And moreover, if I had to kind of give you a punchline of what makes this model different, is that my model, ironically enough, is the one that makes the least amount of assumptions, right? So at least at this stage, I'm only the basics of what's in this setting in order to explain the patterns in investment in the data. Okay, so less assumptions. Hopefully they do a job at explaining the data, which of course would say that some of these extra assumptions being imposed in previous models are not necessary. But we'll see how it goes, right? It's still a work in progress. Okay? Yes, Jeremy.
How do you think in terms of writing different authors, writing different models, and they all go to the same question, which is what you're seeing here?
Yes, exactly.
That's a way we think about structural, to trying out different models?
Yes. When it comes to this particular topic, it seems like it's important enough that we have multiple structural attempts at understanding this topic. So I would say that when it comes to my attempt, because of these two previous papers, it's no longer just about writing out a model. I have to be able to pinpoint about something missing from my model that they need in their model to explain the data, or the other way around. So again, this is just like the behind the scenes of what I was thinking about as I was going through the mathematical expressions, right? So I have a function for the T-1 optimal level investment. It's not a function that I can write down analytically, but just to remind you again, it exists in code form, right? So right now, right, this function exists on my computer, and it tells me that for any level of stock, i.e. the k at T-1, I should be able to make a prediction about the optimal level of investment. Okay? Now, let's go to the T-2 optimization problem. And this looks a little bit messy, right? So again, I'm not very good at expressing these objective functions with mathematical elegance, so I just sort of took the brute force approach and wrote down all the pieces. Okay? But the point here is that I can, by writing this down, I have everything expressed in terms of the parameters, which up to now I'm going to assume I know. And the only other thing this optimization problem depends on is the k at T-2, the stock level, which at T-2 should be exogenous, and it's going to depend on the profitability at T-2, which the manager observes. Okay? So if I'm a manager, I can take something that is exogenous and observed, and something else that is already observed, and I know all of the parameters, so I can just go and solve this very messy optimization problem. Okay? Unfortunately, this optimization problem is messy enough that, of course, I cannot write down the first order condition analytically. Okay? We will go to using a numerical solver again, but even though you cannot do an analytical expression for the optimality condition, it still makes sense to check whether the optimization problem is smooth. Okay? So in terms of making choices about how to solve for that optimization problem numerically, it helps a lot if you have done some work to show that the function is smooth, and therefore you can use some sort of approach and some sort of gradient-based approach, and that will make your code run a lot faster. Okay? So that is the one new issue here. So when we use the F0 for the T-1 manager's problem, at T-2 we cannot use that function anymore. And there's going to be a new issue. If you go back to the T-1 problem, because the z at T-1 enters into the objective linearly, then you can just apply what we know about linear transformations of random variables, and that's what allows you to compute that expectation in closed form. When we go to the T-2 problem, you will see that the optimal investment policy is no longer a linear function of the profitability state. Therefore, sort of this optimization problem is a nonlinear transformation of something that is fundamentally random. And because of new complication, whenever the manager goes to solve for the expectation of future profitability, then of course we have to calculate an integral over the density of the distribution of the different z's, right? So how do we overcome these two new issues? I think the top slide should say in solving the t minus 2 problem. So in MATLAB, I would use one of the optimizers, either fmin UNC or fmin search, to look for the optimal investment level. And the difference between those two depends on what you think about the smoothness of the objective function. So basically, one of them uses a grid search, which is more robust to sort of the ill-behaved objective functions. But if you convince yourself that you are working with a smooth objective function, then of course, the fmin unc, which is based on a derivative method, is going to give you a faster convergence. Yes?
So at the point you start putting strong restrictions on the parameters, you say, I'm just going to set theta equal to 1, I'm just going to set delta equal to 0.
Right now, the answer is. Okay? And we will then relax that later, basically. Okay? I told you before that you can, at this point, start calculating numerical derivatives to that of manager's objective function. So it doesn't take too long to write a program to take numerical derivatives. You basically vary I by just a little bit and consider the change, and it's basically sort of the fundamental calculus method for doing that calculation. Why is it a good investment to do it? Well, at some point down the line, when you go start calculating standard errors for your parameter estimates, then you're going to want to consider a derivative-based method because standard errors is based on sort of the first and second derivatives, right? So if you're invested to doing structural work, it's good to have that piece of code somewhere in your arsenal in this process. Okay? So this is my programming recommendations for how to solve that t-2 already pretty gnarly problem. What about the fact that the random variable enters into the objective function nonlinearly? You have a couple of choices. And again, sort of, I went for the easier one that takes like 10 seconds to program, which is to simulate from the distribution of z's, right? So if I go back to my code here, then assuming that we know what the variance of that error term is, then we can just go to MATLAB and do some draws from the normal random distribution. Okay. Just another tip here is that whenever you go simulate draws in sort of any software language, it's a good idea to fix your draws up front so that you run this code over and over again, you know that any differences you get sort of in your estimates and your solutions is not coming from the randomness of the draws that you're taking. So that RNG 1987 line is my way of fixing the draws. Okay. Which one? I will share this, or we can talk more offline. Okay. So simulation would be the low-hanging fruit to go for here. And again, if you're just sort of doing exploratory work, simulation is enough. It turns out that if you're trying to integrate over density, there's more efficient ways. You are drawing equally from all points in the sample space for a normal distribution. What you want to do is to place more weight whenever you draw from the more extremes of a normal distribution, so that when you do the integral and weight it appropriately, you come up with something that converges quicker to the analytical integral. So that's a lot of nerdy talk that I learned from I believe it was a marketing course. But the bottom line is, again, if you foresee having to calculate numerical integrals a lot, you might want to consider like a quadrature approach. And there's various quadrature approaches you can take, which I believe either Jeremy or Frank is going to cover. The downside to doing numerical integration, of course, is that it's not, it becomes intractable if you have to integrate over multiple dimensions of density. So for those cases, you probably have to go back to simulation. MATLAB has these numerical integration features. I can't attest to whether they're any good or not. As with all sort of built-in packages, you should understand them they're using and what kinds of judgment choices they're making for making approximate. Okay? So before I wrap up this discussion of what I can do with these two functions, I'm going to share with you some preliminary conclusions I've made on the analytical front. Okay? So if I go back to my t-1 problem, I'm going to find that it has to depend on two variables that are exogenous at t-1, which is the observed profitability and the observed of capital stock. Okay? Now, if I think back to the descriptive studies about real effects and the investment choices managers are making, well, let's talk about what assumptions they've made there. Okay? How many of you have seen a descriptive study where the left-hand side variable is the delta in the investment? I'm going to embarrass Eric here again. Hi, Eric. Have you seen this type of study? Look familiar? Okay. Eric's paper, right? Yes. And Eric, why did you use that as your left-hand side variable? Why the delta?
What is delta?
Yeah.
Instead of looking at the levels?
Or why not investment at t-minus 0.8, investment at t-1? Minus 0.4, what minus 1 over pi?
All right, I'll get that.
Okay, so you are making the claim that the delta in investment levels is the right one, the right outcome variable to consider. Okay, well, let's see what the model thinks about that choice. Okay, so for now, let's get rid of the component about in this model, which is the adjustment cost. So let's just normalize psi to be 0. In the past, researchers have found it's not equal to 0, and they've actually done some rigorous testing. So it turns out, make that assumption, then at t-1, the optimal investment looks like this expression I've given you up here. Okay? And what does I star depend on? It's going to depend on capital stock, and it's going to depend on profitability, but look at all of the parameters that are floating in there. Okay? Well, I'm going to make a hypothesis about the motivation that researchers have when taking the delta investment, and it's because of this idea that investment levels tend to be sticky for companies, right? So when investment is sticky, then maybe taking the delta seems to make more economic sense. Okay? So all I've done is given you the optimal expression predicted by theory about investment levels, and you will see that investment can be sticky. And it's sticky because they are all they're all related to the profitability and the capital stock. So the stickiness is arising endogenously in the model through the stickiness in those two variables. Okay? So that's the number one insight I got. Well, what happens when I take the difference between I star at t-1 and I star at t-2? Okay? Does that get me anything close to one of those variables? In general, it's going to depend on some function of all of those parameters. It's going to depend on rho, it's going to depend on theta, it's going to depend on delta, it's going to depend on beta. Okay? And even with this simplifying assumption, I'm not going to get a place where the delta in I stars predicted by this model is going to avoid any of those parameters or any of the z's or k's. Right? So when it comes to doing descriptive work, sure, we can put the delta investment on the left-hand side, but look at all the assumptions you have to make in order to make a claim that the outcome variable we're interested in is, in fact, the delta in levels. You would have to make an assumption about delta, you would have to make an assumption about beta and theta, and some assumption that the k and z's just happen to be a function of betas and thetas, such that when you difference out the two I stars, something that's an economic primitive. Okay? So the punchline here is, yes, in this case, I'm making assumptions about the parameters, but in this case, I'm being very explicit. I'm assuming theta is equal to a value, beta is equal to a value, and delta is equal to a value. When the descriptive studies just take a delta in the investment levels, they are making assumptions too. It's just they are not stating it. So this goes back to the theme that I talked about in my first presentation. And when we're doing empirical work, every kind of empirical work, whether descriptive or structural, makes assumptions. Okay? Only difference here is that I'm making my assumptions very explicit. And in this case, at least I'm making an assertion about the numerical values. In order to rationalize using the delta in investments as the outcome variables, you would have to make an assumption about the values that coincidentally line up such that the two I stars, when differenced out, eliminate and cancel some of those variables. Right? So this is sort of what the theory would tell you very early on just by working through the two-period problem. Okay? All right. We're in the home stretch. Okay? So this part is going to be a little bit dense, but I promise you the last part is going to be a little bit lighter. Just to recap, what were we able to get from the model? We have the optimal investment policy from the manager's perspective if they observe their K and a Z, and we have this investment policy for both T-1 and the T-2 period. Okay? Just to remind you, even though we don't have it written down, it exists in computer code for T-1, we have that in this little function here. And for T-2, we have that in this function over here. Okay? This messy line item is just the manager's optimization problem at T-2. Again, this is not very elegant at this point. If I were serious about overlaying additional elements of the model on top of this, I need to clean up that expression quite a bit. Okay? So we have this function stored in computer code. Now, from the econometrician's perspective, we have to think about the fact that we not necessarily observe Z. Okay? Z is observed to the manager, but not necessarily to the econometrician. Having said that, if we assume that we know the distribution over Z is that parameter which governs the persistence of earnings shocks, then we can compute an expectation, right? So we can simulate from the distribution of the Z's, calculate the P function for T-1, the Q function for T-2 to come up with the econometrician's over the optimal investment for every given level of capital stock. Okay? So this is what the model tells us. Well, what should the data tell us? The data is going to give us some joint densities about investment and capital stock, and it's going to give us these densities for CEOs with long horizons and CEOs with shorter horizons. Okay? And right now, we are using sort of the short and long horizons in quotes because we can roughly observe those horizons in the data. Of course, I know those time horizons are going to be endogenous to many of the components in the model, and it's going to be not completely realistic to the model that I've written down so far. But right now, I'm saying that it's close enough. Okay? So I said that the data gives us a joint density, and one sort of obvious object we can calculate from that joint density is a conditional expectation of investment given the level of capital stock. Okay? And how do we describe that joint density? Remember what I said in the first session about how to do descriptive work well? Well, I would just start by taking graphs and just plotting out the non-parametric relationship between those two that you see in the data. Okay? So the model is going to give us comparative statics of what we see as we vary the CEO horizon from t-1 to t-2. And of course, the data is going to give us that comparative static as well. There's one problem, of course, is that throughout all of these functions I've written, I've left everything as a function of the parameter values. So the theta, rho, delta, and z bar. And from the econometrician's perspective, we don't observe any of those parameter values. Okay? Well, what do we do? Just as a first step, we make some assumptions. And we're making some assumptions so that we can see how far those parameters get us in terms of explaining the data. Where did I get this assumption from? This is basically sort of, I think it's table 3 or 4 from that Breuer and Windus-Schisch paper that I talked about in my first session. Okay. What they did was they calibrated 2 parameters, the average profitability and the noisiness of the earnings process, but then they took some of the other economic primitives from previous work. So before going on to kind of what I'm doing in my little project, I'm just going to briefly talk about how to defend the choice to use parameters from previous papers as the numerical assumptions in the model you're working with, rather than estimating it altogether. In terms of what Matthias and David were trying to do in their paper, they were trying to explain something about the earnings and return relationship. And so it turns out that they only need the 2 parameters to be able to get close to what you see in the data. What they could have done is done a full-blown estimation for all of these parameters. In order to nail down all of these other parameters, they would have needed to use variation in the sort of the temporal value, the temporal variation in investment, and some other trends like the covariance between prices and investment that were examined in Strebulev and Whitehead, for example. Right? So I think one way they could have made a case for why they were assuming some parameters and then calibrating the other ones is to say that we are only interested in explaining this one particular phenomenon, and we don't need to make adjustments to some of the previously estimated parameters in order to explain that phenomenon. And if we did want to make those adjustments, we would be asking about a totally different question. Okay? So I think for their paper, it was fine to calibrate or estimate a set of parameters, but assume values for the other parameters. And for the purposes of this toy project that I'm starting right now, I'm just going to take everything as given from that previous paper, and then I'm going to plug it into the model. Okay? So after I plug in these parameters, I can produce a set of results. Right? So in the data, I see some conditional expectations of how investment varies with capital stock. I can examine pattern varies in the data as I look at different CEO horizons, which with the right data you can observe. Okay? And then model the P and Q functions that I wrote down in MATLAB and ask whether those comparative statics are also predicted by the model itself. Okay. At this point, all I want to do is consider some comparatives, right? When I turn the dial on the time horizon in my theory, do I get comparative statics that also manifests itself in the data? Okay. So at this point, I would say this is the primary result that you want to go after in your structural paper. I haven't done any estimation, any simulated GMM, any routines that require fancy econometrics. But depending on what I get from this exercise, I can tell the audience that there's something in the theory giving rise to a numerical comparative statics, and I see the same numerical comparative static in the data. And that is the end goal of doing structural work. Okay? So as you can tell, this project is, well, not going to call it a project yet, just something I'm doing for fun for the time being. But there's two ways to go, right? After I hit execute on the code. And it could be the case that the model and data line up, and it could be the case that the model and data don't line up. So let's talk about the bad scenario first, which is you can't get the comparative static that you need to see from the model behave the same way in the data. And it turns out that with structural work, it's not seeing this consistency between data and model does not mean that you get a null result in the same sense you get from running a descriptive test. Okay? So what do when you don't see the predictions line up? First of all, you relax your assumptions about the parameter values. So I made one set of assumptions about those parameters. Can I make a different set of assumptions that I get a better fit between the and the theory? And of course, to the extent that you can explain the data better with different parameter values, then you still worried about reconciling your new parameter values with what these previous researchers have found, right? This is what I would call sort of an over-identification problem, right? You have more facts to explain than the number of free parameters you have. So that construct, you had to reject one of the other facts that you see in the data to explain the fact that the numerical fact that you are working with. And whether or not you want to make that trade-off depends on how important the previous results were sort of in the context of the literature, right? And if you were really concerned, of course, you have more complete such that the your finding is able to fit both your numerical facts and the facts that are documented in previous research. Okay? So this is going to be a judgment call. Of course, making your theory more complete to fit data better sounds easier than it actually is, right? So in practice, you're going to have to go back and forth between those. So this is what I would do if my first set of tests don't pan out the way I expect it to. If I find promising results based on this first comparative static, I'm then going to have to think about sort of how do I develop it into a richer model. Okay? So I would imagine that for any structural modeler who tries to present their work to a workshop, there are going to be many hands raised to helpfully suggest to the researcher that they're going to want to incorporate more aspects into the model. And it only takes 10 seconds for someone sitting in the audience with popcorn in their hands to think of something that you could incorporate, right? But in reality, as you work through a structural model, incorporating something tiny additional is going to create nightmares in terms of your numerical solver, and it's probably going to increase your computational time quite a bit, okay? So that would be the practical concern you want to think about. But of course, that's not how you would respond if you get that question in a workshop, okay? So here are some of the trade-offs I would think about when you potentially make your model more richer or more complete, okay? So you're going to think about how much additional computing time you need, but you need to ask yourself, does adding that additional features from an institutional perspective? So consists of going out and talking to the agents that you're modeling and just surveying them or just interviewing them, saying sort of, have I missed out on something critical that I need to consider in your own decision making? Okay? Some of the other considerations you're going to keep in mind has to do with how interesting is that additional feature from sort of a micro theory perspective. Am I going to be extending my model in a way that gets me to an interesting underlying economic primitive, such that when I turn the dial on that primitive, I'm going to come up with more interesting counterfactual predictions. The final consideration you have to have in mind is this idea of what variation is going to help you identify that additional piece of the model. Okay? It could be the case that with all the data you have in mind, well, anytime you have all the data that you're working with already, anytime you add additional features, it's going to give rise to predictions that you will not be able to distinguish in the data. So that's an observationally equivalent model. So you could have a simpler model, you could have a richer model, but because your data is limited, there's no way to distinguish between those two models. So that would be sort of a limitation that the person asking you to accept as part of doing empirical research. And definitely sort of keep all of these considerations in mind, and also alongside try to think about how you can make the computation faster every time you add an additional feature. For example, you can think about sort of pre-calculating a lot of the investment policy ahead of time for a broad range of investment values, so that every time you make a new guess, you can do some sort of interpolation to get close at the optimal investment policy. The second thing I want to do, if I find that my first comparative static generated from the model actually pans out in the data, is of course to increase robustness. So these would be the typical considerations you would have in mind when doing descriptive work, right? So to the extent that some of these investment dynamics and investment policy is going to vary across industries, you can think, for example, the delta might be heterogeneous across firms. We can either write out the parameters as an explicit function of firm level characteristics. That is one choice you can make. Or you can perform this estimation separately for within industry. Okay? Finally, one more sort of additional analysis that I might want to layer on is lining up the model against some of the exogenous variation that we observe in the data about the shocks to CEO time horizon. And poor Eric, I'm going to pick on him a lot. What would be an example of an exogenous or something you could defend as plausibly exogenous shock? Natural. I have a better idea. How about capital gains taxes? That's the one you use in your paper, right? Yeah. So I could think about how I can adapt my model to allow for changes to capital gains or tax rates in general that would shift the CEO's time incentives. I could ask the model to give me a counterfactual prediction about the change in investment levels I would see, and of course, I could go into data and figure out whether those the predictions line up. Okay. So this is going to be just a recap of how you would start doing structural modeling, right? So there's many steps and many more milestones that I have to clear ahead of time. But I would say that sort of most of the investment you make to convince your audience that your question is important and you need to use a structural approach to address that question has nothing to do with simulating methods of moments or any of the estimation techniques. You might not even need to go to the value function iteration that I talked about. Okay, so to develop this paper further, like I mentioned, I would have to sort of talk to some of the folks who have expertise in how these decisions are made in real life. So that's going to take investment. And along each of the steps of the way, I'm going to have to do debugging for every layer of function that I write in my code. And as some of you saw, sort of if you came in before I started today, it's really easy to just screw up sort of one section of some of those objective functions. As I develop these functions numerically, I'm going to also have to think about adjusting my theory, right? What changes do I have to make the theory? Would I have to make the theory to fit more realistically to my data. And in practice, a full structural paper takes some iteration between all of those elements. Of course, down the line, you might actually have to simulate out some moments. You might have to do some formal estimation and test the fit of those estimates. But I would say that those should not be your primary concern at the moment. So that would be it in terms of the toy example of structural modeling. And let's finish it off today by talking about how to get trained in some of the tools I just showed you. Right. So this presentation is again inspired by some of our Duke PhD students who over the years have come up to me and asked me sort of how to get trained in doing structural modeling. Hi, Eric, again. Right? I think Eric has asked me this over the years, and a lot of PhD students have been really intimidated in terms of where to get some of these the necessary technical skills. So I'm going to go over what you can and can't get out of the coursework, and I would say that what none of these courses will teach you is, of course, how to ask important questions. And at the end of the day, sort of that's what you are going to have to learn as part of being an accounting PhD student. And time permitting, I'm just going to recap sort of what's been done in terms of structural modeling in these other fields where they were able to successfully integrate either a quasi-natural or a true experiment and use the advantages of both of those types of both structural and experiments to strengthen the inferences. Okay? To start off, which courses are not helpful? So I went to the Duke course catalog, I went to the Stanford course catalog, I went to a lot of course catalogs across PhD programs, and I just did a search for structural modeling. It turns out that in psychology and other behavioral fields, they use structural modeling to refer to a different technique, and I'm generally not as familiar with their research methodology, so wouldn't suggest you take any of those courses. With statistics, right, if you are comfortable with the material in an introductory econometrics course, that's going to be enough statistics. Finally, when it comes to machine learning, I think it's really cool. And it turns out that it's being exploited quite a bit in sharpening the researcher's ability to make causal inferences. So that's some of the work that Guido Imbens and Susan Athey have done. So definitely really interesting, and I've given you resources that you can go and get pulled up more, but they're not going to be that helpful in terms of your structural modeling efforts. Okay, the courses I found most helpful were in industrial organization and marketing. Marketing is sort of maybe a subfield of IO. And that's because, of course, IO, by its definition, is a discipline that is built upon doing structural modeling. And at Stanford, this was divided into two sequences, but at most universities, they have a separate component about demand estimation and a second piece discussing auctions and other types of empirical games. I will have to say that demand estimation itself is not particularly helpful when it comes to applying it to accounting settings. When it comes to auctions and empirical games, I think there's a great deal of potential in terms of thinking about those problems in some of the accounting questions that we typically ask. So as you will see, for both Pietro and myself, our dissertations were inspired directly by concepts that we saw in an auctions class. So sort of in IO, there's a long literature examining sort of what we learn about the auction bidder's valuation of an object from looking at the numbers that they actually bid. There's a lot of sophisticated econometric theory that's already tackled sort of what you can and can't identify. So of course, in Pietro's case, he was able to say something interesting about the average true borrowing costs for banks relative to the observed LIBOR forecast that banks report. And in my dissertation, I was able to recover something about the distribution of analysts' forecasted beliefs relative to the distribution that they actually report. Okay? So I would say IO and marketing are the ones that you want to focus on. The caveat is that when it comes to IO data sets, there's generally they have an advantage because they can assume that a lot of their observations are IID. And because of that IID feature of their data set, they can recover a lot more interesting objects than we are able to get from accounting data. Okay? So if IO is the sort of more general, the older line of research, quantitative marketing is sort of a specific application subfield of IO. So the trade-off here, if you were thinking about the two courses, is that marketing is going to be more specialized. They consider sort of very particular types of markets and very specific types of phenomenon happening in those markets. So just topically, it's not going to be as interesting. But on the other hand, those classes tend to be smaller. They're kind of offered by the business school. And as a result, you get a lot of hands-on practice doing programming, if that's the component of doing structural modeling that you find intimidating. Oftentimes, you will have students who come into the class with less preparedness in terms of some of these econometric techniques. So it'll be less intimidating to ask questions, and just you will get a lot more hands-on practice. So I've listed all of the laundry list of techniques that I was able to get out of a marketing class, just from that small sort of one-on-one interaction, and just the ability to get feedback sort of on how I'm writing my code. And throughout the process, this is how I sort of developed some knowledge about the underlying computing principles, whether sort of why low-level languages work better than more higher-level languages. What's happening when I put a loop in MATLAB? Why is it so slow? How can I make the computer think a little bit faster? So, these are techniques that you will get sort of a very deep exposure to. Okay? Outside of IO and marketing, here are some other courses you might want to think about. I would think that most of your PhD programs require you to take some degree of econometrics, and some PhD programs offer additional econometric training beyond the compulsory ones. So I would say if the additional econometrics training is going to teach you about how to develop new estimators, show consistency and convergence, then forget it. But if you're going to sort of do something more hands-on, like bootstrapping, or some of these newer estimation approaches, like simulated general empirical likelihood, that's the term I'm looking for, which is a kind of a hybrid between maximum likelihood and general method of moments. Those would be good concepts to learn as well. If you were thinking about taking an empirical corporate finance class, I would say sort of structural work is not applied broadly in that area yet. Having said that, that area is very much dominated with sort of experiments, so different estimators and regression discontinuity estimators. And I found those courses to be useful if I want to become very good at defending some of the assumptions in those settings. Finally, you might want to also think about sort of the miscellaneous field courses in the econ departments. So traditionally, the way econ departments are organized, you get your micro, macro, and econometrics training in the first year. In the second year, there's these field courses that are targeted towards economists with specific interests. And I would say structural work is used to varying degrees in these fields, but in general, it might be helpful just to see how your econ colleagues think about very similar questions relative to what we think about. And the ones that I've identified here have to do with labor, and I took a course on the economics of communication, which again is very much applicable to the disclosure literature. And then the other advantage is that for most of you going on to faculty positions, when sort of your renewal case and tenure case is up to the committee, oftentimes one of those committee members will be someone from another field in the business school. So as sort of you work towards becoming a faculty, it's always a good idea to understand how some of the faculty in other areas think about research and how to sell your research to those audiences as well. Okay. So I'm going to end the day with some fun examples of how in other fields they've been able to apply experiments to structural models. Okay, so the first one is one of a series of papers that these guys have written in the area of empirical contracts. Okay, so they're going to model a setting in which the workers get paid a salary and a bonus. And as we know in real life, bonuses are not structured in a way that's first best or even second best from a contracting perspective. And instead, they have these features like quotas and bonuses and ceilings on the bonuses, as well as these ratcheting schemes. So these ratcheting schemes, they say that depending on the performance you have this period, your next period's bonus plan is going to be calculated based on current period performance. So we're going to have some distortion in behavior that sort of a classic Holmstrom model would predict. So what these guys went out to do is to estimate the Holmstrom type of model on actual data. Okay? And of course, they can't apply the Holmstrom model literally. They have to extend it to allow for these real life features. But basically, sort of the underlying parameters they estimate is going to be the same, right? So it's going to be related to the risk aversion on the part of agents, and it's going to be related to the cost of effort. Okay? So what they were able to do with structural modeling, which sort of most of you have heard over and over by now, is make a counterfactual prediction. So given the parameter estimates about the agent's risk aversion and cost of exerting effort, they can say something about the effort and the productivity that we should expect to see if we make a change to the bonus plan and to their incentive plan. Okay? So with this prediction ahead of time, they were able to go into a real life company and implement that actual change with the real life. And this company not only let them run this field experiment, they gave them both the pre-contract change data and the post-contract change data. And of course, with that post-change data, they can line up that data against the prediction. And in fact, they found that the numerical prediction they made from a structural model about the change in productivity after changing the contracting mechanism design lines up numerically with the change that you observe after implementing the field experiment, right? So I would say sort of when faced with the criticism that structural modeling makes too many assumptions and assumptions aren't realistic, well, this would be one powerful piece of evidence that even with these stylistic assumptions, there's something to the model that would match up with what you see in real life. And as you will see here, this topic is not necessarily like a uniquely marketing question, right? When it comes to how to provide incentives to workers and how to write optimal contracts, that is something that we're very much interested in managerial accounting and in the CEO contracting space from both a theory and an empirical perspective. Okay. The next one I wanted to talk about is a dissertation by this PhD student at MIT. I think she's at Harvard now. So I think strictly her field is development economics, but you will see that the question she's working with has to do with asymmetric information and learning and verification, and all of those features apply in the accounting setting as well. Okay? So the particular object that she's studying has to do with watermelon sales in a Chinese market. Okay? This is a little bit of a fun one. And if you go to her online appendix, there are all these cute pictures of watermelons. And I suppose that makes the job talk a little bit more interesting. But the basic problem that economic agents face with has to do with whether or not to buy a watermelon. And that, of course, depends on their beliefs about the quality of the watermelon. Okay? So we see this feature in accounting data all the time. And just like how in accounting data, we have an issue about whether managers can credibly signal their quality. In this watermelon market, the current setting does not have any technology where the seller can signal the sweetness of the watermelon. So what she was able to do is she was able to go in the field and randomize certain watermelon sellers to receive a verification technology that the sellers would not otherwise invest in. And then using this randomization and a structural model, she was able to recover some underlying economic parameters about the basically the verification technology and the consumer's response to verification. And as a result, she saw some results about sellers being able to actually invest in higher quality because they can then go out and get it verified and signal to the market. So again, this is sort of a marketing, potentially development economics topic, but we can see that there's some potential about applying it to sort of the auditing technology for accounting numbers as well. Okay? So the last one that I wanted to cover, and I think this is a good one to end the day with, has to do with applying structural modeling to two-sided markets. Okay? So where do we see two-sided markets in accounting? Auditor choice is one example that's fairly obvious, right? So in two-sided markets, there is a convention that anytime you give the agent a bigger menu of options, then it unambiguously increases welfare. But there's some theory that predicts that it might not be the case. And so that's all I have for this afternoon. You guys had really good questions, and for any of the topics I listed here, if you're interested in thinking through further questions or potential projects, I'd be happy to kind of discuss with you further. All right, thank you.